Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at iron.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. We're looking today at a company that has really completed an extraordinary transformation.
And in a very short amount of time.
Exactly. We're talking about iron, and the story here isn't just, slow incremental growth. It's a major operational inflection point.
Right, moving from that sort of commodity-exposed Bitcoin mining
To a high-growth AI infrastructure play.
And when you look at the raw numbers, the sheer speed of this pivot is what's so striking. I mean, this isn't some 5-year plan.
No, not at all. We are seeing the results of decisive action really taken within the last 18 months. The numbers, you have to see them as validation of that new strategy.
So for fiscal year 2025, total revenue was what, around $501 million?
Yeah, $501.0 million, which is a 168% jump year over year. But, the critical change is really the earnings quality.
That's the part that stands out to me, the complete reversal in profitability.
It's a textbook turnaround. They went from a significant net loss, I think it was about $28.9 million in fiscal 24, to realizing $86.9 million in net income just 1 year later. That signals that the new business segment is generating real, actual profit, not just top-line revenue.
And the margins tell a similar story.
An even more telling one, I'd say. The adjusted EBITDA surged by 395% in FY 2025.
Wow.
Yeah, reaching almost $270 million. That kind of growth gave them an industry-leading margin of 53.83%.
In digital infrastructure, expanding margins that fast tells you that the capital is going into a very high-demand, high-return area.
It's the clearest proof that the pivot to AI cloud services is working.
And that momentum, is it continuing? Because annual results are one thing.
Well, looking at the most recent report, Q1 of fiscal 26,
Yeah.
the quarters that ended September 30th, the acceleration is stunning.
Yeah.
Revenue hit $240.3 million.
Which is a 355% increase year over year.
But just hold on to the net income figure for that single quarter. A record $384.6 million.
Wait, for the whole previous year, it was $87 million, and now it's $384 million in one quarter.
Exactly. That is exponential earnings generation. That jump validates the sheer scale of the AI deals they've managed to secure and actually deploy.
Okay, so that leads us to the next point. How do they achieve that sudden, explosive scale?
It's all about visibility. Most companies struggle to project revenue, a few quarters out. IREN is locked in multi-year revenue streams.
Which almost eliminates that forward uncertainty.
That visibility is their primary asset right now. We're not talking about hopes or projections anymore. We're talking about secured, contracted pipelines.
Right, like the Microsoft contract.
The big one. A multi-year contract with Microsoft valued at $9.7 billion.
To put that in perspective, that single contract is over 19 times their entire revenue from fiscal 2025.
And the pipeline isn't just that one deal. To build out the hardware for it, they also secured a $5.8 billion deal with Dell.
Which gets them the NVIDIA chips they need.
It ensures they have prioritized access. Yeah. So they can actually execute on the Microsoft contract. It's a forward guidance built on concrete deals.
And consensus is projecting, what, over 125% revenue growth for fiscal 26?
Yes, but the key is understanding their competitive advantage, their moat. In the AI infrastructure game, the bottleneck isn't software, it's power.
Power is the gatekeeper in the age of AI. These GPU clusters are incredibly energy intensive.
They really are. The company had 810 megawatts of capacity operational as of late 2025. That's respectable.
But the real advantage is what's coming.
The real moat, yes, is their secured pipeline of 3 gigawatts of low-cost power. That's the key.
Structurally cheaper than what competitors can get.
Exactly. And they've been smart about how they use it. They've perfected this dual-engine model.
Using their old Bitcoin infrastructure for new AI services.
Right. They took that same power real estate and pivoted to high-margin AI.
Yeah.
And the profitability, well, it speaks for itself. They reported an AI hardware profit margin of 98% as of July 2025.
98%? That sounds almost unreal for hardware. How does that work? Are they just reselling chips?
It's a bit more nuanced. They aren't just selling the chips. They're providing the entire AI cloud service. The chips, the power, the cooling, everything.
The whole managed package.
Exactly. So that 98% figure is likely the margin on that specialized hardware deployment. It's the difference between their cost, which is low because they control the energy, and the premium leasing rate they can charge for that scarce computing power.
And the big partnerships confirm that position?
It does. They've got preferred partner status with NVIDIA, which is crucial, and of course the exclusive contracts with Microsoft. This creates high switching costs.
So, moving from the operational moat to the financial side of things, you can't secure a $10 billion deal without some serious capital up front.
Correct. Execution at this scale needs a fortified balance sheet, and while their business is cash generative, almost $246 million from operations in fiscal 25, the build-out required massive external funding.
Which is where the recent capital raises come in.
That's why we saw the $2.3 billion convertible note and the $1.6 billion equity offering.
Now we have to talk about the dilution. The equity offering, that inherently dilutes the state of current shareholders.
It does, and that's the elephant in the room. But the market seems to accept it because it radically de-risks the execution of those huge contracts.
You're trading a small piece of future earnings today.
For the near certainty of billions in high-margin cash flow tomorrow, that capital raise, the $3.9 billion, it moves IREN from being a theoretical player to a funded utility that can actually deliver.
So let's talk about the market's reaction to all this. The stock had a phenomenal run.
Absolutely. Up between 270 and 300% year to date. A run like that, it naturally invites some profit taking.
And we've seen that pullback recently. The stock closed around $40.30, which is down about 40% from its peak.
Technically, this creates a very interesting setup. We see this $40 to $42 range as a constructive consolidation zone.
A chance for the stock to sort of breathe and build a new base.
And for investors who missed that first surge, this pullback could be an attractive entry point. The long-term trend is still firmly in place. It's trading well above its 200-day moving average.
The barometer of long-term health.
Exactly. And let's look at who else is getting involved. The institutional ownership is robust, sitting at 41%.
So sophisticated capital is positioning itself.
You see it in the flows. Jane Street added over 5 million shares in Q2 2025, a 152% increase for them. Further Finance also significantly upped their position.
This shows that smart money is actively accumulating in this zone. What about the news that Paul Tudor Jones trimmed his stake?
You know, that always raises eyebrows. But when a stock has run 300% in a year, a legendary macro investor trimming is more likely disciplined risk management.
Not a loss of conviction in the core story.
I believe so. The fundamental AI story is still sound.
Okay, we've covered the opportunity, the moat, the funding. What about the risks? What could derail this?
The number one risk, by a wide margin, is execution risk. They've raised $3.9 billion, but we're talking about fulfilling a $9.7 billion contract. There are still valid worries about a potential funding gap to meet the full demand.
It's a massive undertaking, so how do we know management can pull it off?
Well, you look at their track record. The team has already shown they can execute with that 395% EBITDA gap growth. And the capital raises, while dilutive, have substantially de-risked that funding gap concern.
Okay, what about the legacy business, Bitcoin?
That's the secondary risk, Bitcoin price volatility. If Bitcoin were to, say, fall back below $40,000, it would compress their mining margins.
And could reduce overall profitability by what, 15 to 20%?
In the near term, yes. It's a risk you can't ignore. But the mitigation is that the AI business is the real growth engine now, and it's largely insulated from Bitcoin's price swings.
And management has already shown they're focused on AI.
They have. They proactively stopped expanding their Bitcoin mining capacity at 52 exahashes per second. That's a clear signal of their strategic shift. They reallocated that capital directly to AI.
So with the risks manageable and the funding in place, what are the near-term catalysts that could spark the next move up?
The key one is the Q2 earnings report, expected around February 11th. That report is crucial. The market will be looking for continued clarity on that AI revenue ramp.
And updates on the Microsoft contract deployment?
Absolutely. Any announcement in Q1 about accelerated deployment or committing new tranches of that big deal could easily trigger a significant move.
And looking further out into 2026.
There's a big speculative catalyst. With their preferred relationships with Microsoft and NVIDIA, the market is anticipating potential new hyperscaler contracts.
From Amazon, Google, Meta.
Securing another one of those would cement their status as an essential utility in the AI space.
Finally, let's touch on valuation. There's a huge range in analyst price targets.
A massive dispersion, yeah. From a low of $24 to a high of $100. That just reflects the high-stakes execution risk the market is pricing in.
But the median target is what, around $55?
$55, yeah. Which implies about a 36% upside from the current level. Given the secured pipeline and the de-risking they've done, the risk-reward profile here looks pretty attractive.
So to sum it all up, this is a company that has navigated a rapid transformation, they've proven profitability, and they've built a real moat with their power capacity and partnerships.
The story is no longer about Bitcoin. It's about controlling the energy supply for the AI revolution.
IREN represents a high-conviction, asymmetric opportunity for investors, especially with this pullback offering an attractive entry point.
If you want to keep track of how this massive infrastructure build-out develops and whether those Q2 earnings catalysts fire off as expected, make sure you're subscribed so you don't miss our next update.